Hello, everyone. It's Larry Kotlikoff back with Economics Matters, the podcast. My special guest today, Fred Lane. Many of you know Fred from two prior appearances on Economics Matters. Fred is a head of Lane Generational, which is a investment company. He'll tell us about that briefly, but um, he's a long-term portfolio manager. He has 40 years of investment and corporate finance experience. He's a private equity investor and also an investment banker. Prior to coming to forming Lane Generational in September 2020, so we're now talking about 5 years ago. Fred was senior vice president of investments at Raymond James and Associates, and before that, he was uh, chairman and CEO and founder of the investment banking firm Lane, Berry and Company. And then before that, he was managing director and principal of DLJ. It's a fabled investment company called Donaldson, Lufkin, and Generette. And he was influential in the growth of DLJ's investment banking business. He also served as co-head of the mergers and acquisition department at DLJ. And then he was a managing director, senior advisor of Credit Suisse, First Boston. So he's really, had lots of experience in major financial companies. He's also been an advisor and an investor. He was a founding investor of Staples. That was a brilliant investment for certainly. Advanced Micro Devices, Forest Laboratories, Ultra Beauty Tractor Supply, Berlitz International, Rexnord, Fairchild Industries, Plantronics, and major other interesting and successful companies. Also, all in all, he's invested in more than 80 private companies. So Fred is somebody who does his homework, and he has this company, Lane Generational, which is a mutual fund that he runs through Fidelity Investments, and everybody can invest with Fred. I'm going to ask Fred to fill in anything I didn't say about his uh, bio, except that I know that he rode crew for Harvard, and he should probably be coming on here momentarily to defend Harvard against its attacks from the administration, but like a good Harvard man, and but uh, but also uh, I think he started his career after Harvard in accounting and then got into the investment world. So he has a CPA in addition to a Harvard crew degree. I'm not sure what you majored in at Harvard.
Well, I
Uh,
majored in English, and actually I went directly from Harvard College to Harvard Business School, and then I went to Coopers and Lybrand, where I became a CPA. Yeah, yeah.
okay, I left out the
So I actually value grammar, but I also value math skills. And oh, by the way, you may have read that Harvard is instituting for freshmen, as required, a remedial math course for basic math skills, which tells you something about what the elimination of standardized tests has done to the undergraduate body at Harvard as it relates to at least certain skills.
Yeah, I've noticed this at Boston University. We have a lot of people that I teach an advanced macroeconomic undergraduate course, which just I could use calculus. I just use high school algebra. High school algebra floors about half the kids. Uh,
Absolutely. It's absolutely, you kind of wonder, where are we spending our education dollars? In California, 80% of the dollars are for administrative functions. It's like, huh? I mean, really? I mean, we're talking 80% of, hundreds of millions of dollars. It's incredible.
well, that might be teacher. Could include teachers as opposed to principals, but
Larry, I'm all for teachers, and I'm also for for families that actually take responsibility for educating their kids. I'm sure you did, and I know I did.
I know the Department of Education, rather than tearing it down, the smart thing would have been to put up the best five algebra teachers online so people could take short online courses on each topic in algebra or, geometry, every subject, English, history. Why does the Department of Education, which still exists formally it's a shell, but why don't they at least put up some online courses for people to teach to go over with their kids over the weekend or at night, or teachers to use and put headsets on the kids. So the big problem I think is happening in education is disruption. You have kids who are disrupting other kids, and it's chaos. And then the teacher's job is management, not uh, yeah.
And
So
we have the problems with the smartphones, and but you're absolutely right. You couldn't be more right. And again, this gets back to family values and family standards. As you and I have spoken, I don't want to get carried away on this particular topic, but I will. Family values matter, and I don't think there's any group of people in the world who have valued education and pushed for education and pushed for strong ethical family values. There's no other group that I can think of, and I'm not Jewish, but it's the Jews. And God bless them. I mean, and we need and God protect them, because they are, in many ways, I think, the beacon of where civilized society has to continue to evolve. It has to continue to go in that way. And yet we have all these influences going in the opposite way. I'm sorry, I have to get on my little political rant here, because I just feel so concerned about anti-Semitism globally. And I feel so concerned about the growth of groups who want to attack the Jewish culture, which is, as I said, I believe the most powerful culture in the world. 17 Jews in the world, 17 million Jews. Look at the achievement of the Jewish population. It's positively mind-boggling, and should make every goy like me embarrassed, okay, that we are such woeful underachievers. And I think but to me, if you look at that model of values and you apply it to states and cities and locales and education, if you could start to inculcate those values to a greater extent, you're going to
yeah.
have a much more successful educational environment.
Well, there's been some studies done about why Jews have been successful economically over the years. And it really goes back to being if you're kind of pushed into a ghetto after the expulsion from Rome, well, by Rome back in whatever the year, I was 120, I think it was 667 or something like that, when Jerusalem was, the Second Temple was destroyed by the Romans. You have dispersion, or the diaspora, and then you have Catholicism and uh, taking over the world, and then there was ghettos being set up, uh, and Jews were expelled from different places, not just Spain, but England and other regions because uh, of discrimination. But the ghettos, the ghetto in Rome lasted, I think, till like 1860. Uh, so when you're stuck together like this, what do you do? Well, some segment of the Jews were studying the Torah, became ultra Orthodox and religious, and the other segment were trying to make commercially successful through through exchange or through being financial middlemen. Like Rothschild, I mean, he obviously escaped the ghetto, but
Yeah, absolutely.
so the whole history of the Jews. But the interesting thing is that they prospered under the Ottomans, under the Muslims. I think one of the top advisors, or uh, maybe vice president, if you like, of the Ottomans was a Jew. So there were centuries of excellent cooperation between the Jews and the Muslims. It always wasn't this animosity. Let's just talk about the big picture here about the country,
And
geopolitics.
let me just make one comment, and that is, I just want to clarify. Lane Generational is an investment management firm,
Yep.
and we manage, less, $125 million of assets. We primarily serve individuals, a couple of family offices, and our account sizes are as small as 500,000 in some cases, even a little less in some cases, and some much bigger. We are not a financial planning firm per se, and we don't buy other people's investment prowess. We don't use other mutual funds, or we occasionally will use ETFs to pursue certain themes occasionally. But the reason I raise all this is because a lot of what I'm going to talk about today needs to be digested by the listeners by thinking through what is their overall portfolio. What are their needs 5 years out, 10 years out, 20 years out, 30 years out? What other assets do they have? And what assets are likely to be monetized in the future? If you have a business and you're going to sell that business, how are you going to apply the proceeds? All of which is to say that the financial planning process is very important. Larry's only too happy to talk about his software, which is superior. But I do believe that financial planning is absolutely critical. So I want people to understand that nothing I say today is a recommendation as it relates to a sector or even a company. I'm going to try to avoid talking about companies because I don't want to be too specific and have people think, oh, gee, I need to buy that. I'm not in any way recommending that. Anytime we take a position in a company, it's a function of a lot of knowledge that we've built over time. We've read the SEC filings. We'll talk about the process of research, and we've studied very importantly, when are we going to buy? What's our entry point? What's our target price? Ultimately, although we don't, that can be a moving target, and hopefully that will continue to move up. But I do want to emphasize that all of this needs to be taken in the context of whatever the individual's needs are. And so, we don't, if somebody comes in and says, gee, I want to give you X amount of money, our first reaction, quite honestly, is, well, let's have a discussion about the broader context of your life. And I think that's important. So that's a little context on lane generational. And with respect to the context of the environment, Larry, it was interesting yesterday. I don't know if you heard any of it or saw any of it, but Warren Buffett, of course, had the carnival that they hold in Omaha, Nebraska every year, which is called their annual meeting. And it's quite a phenomenon. People flying in from all over the country, and in some cases from outside of the US. And one of the things that he mentioned, which I thought was worth mentioning, is that we've all experienced recently a tremendous amount of volatility in markets. We've seen it in the news. I mean, there's volatility in the news. We're going to have tariffs. We're not going to have tariffs. They're going to be delayed. They're not going to be delayed. We're going to have the Ukraine war is going to end. No, it's not. I mean, what's going to happen in China? Is Taiwan going to get invaded? We've had just unlevel. We live in a world of instant media distribution, a lot of which is inaccurate. Oh, by the way, or misleading. I won't even say inaccurate. I'm not even saying it's intentional. But when you have messaging that's going in different directions, it's obviously very confusing. Buffett made the point, I think it's worth making, that from the beginning of the year until today, the S&P, despite the fear index hitting, I think, as bad a low level as I've seen in a long time in early April, mid-April. I think it hit 12 or something, which is pretty low, 50 being the midpoint. I don't think I've ever seen it as low as 12. Since the beginning of the year, the S&P is down 3.3%. And since Liberation Day, i.e., the tariffs were announced, which caused tremendous consternation, as we all know, the market is actually flat. It is, as of Friday, it regained everything it had lost since Liberation Day. Now, does that change the volatility going forward? I'm not sure. I mean, the VIX right now, which is a measure of volatility, is down to 22. It was running in the 30s and 40s during, much of the last month. A very benign VIX is 12 to 15 to 16. We don't have that, and we have tremendous option activity. We think right now the flows are positive for the market in the short term, but we do believe that there are so many exogenous factors that trying to market time is very, very difficult. And I do think let's look at the last 4 years, and I'll make a comment about that. The last 4 years have averaged about a 15% return on your capital, about 15, more like maybe 14 to 15. with 22 being down 18%. As we know, 2020 was up 30%, which was a little confounding. We were sitting in 40% cash right after COVID was announced, and we never really reinvested that. So we were 30% cash. Happily, we had tremendously good performance because the rest of our portfolio did very, very well. But having said that, that's looking way in the rearview mirror, and the investment business is all about looking forward.
Let's talk about retirement for a minute. It's something Americans think about regularly. Ask yourself, how financially secure do you really feel? Do you have enough money to retire? How much is really enough? And if you don't have enough money, how can you possibly find that extra money before you do retire? These are all tough questions. My retirement software, Maxify Planner, is the powerful online planning tool that takes the guesswork out of retirement. It weighs your assets against your fixed expenses to calculate how much you can safely spend every year for the rest of your life based on when you decide to retire. And it shows you safe ways to find more money. Maxify makes a complicated problem like retirement planning simple. It's accurate, easy to use, and produces what you really seek, peace of mind. So make the smart choice and visit Maxify.com today. Don't miss this opportunity. That's Maxify with an I, M-A-X-I-F-I, Maxify.com. Now let's get back to the podcast. Yeah, let me just kind of add in here that, reading kind of the health of the economy from the stock markets and this policy is a little tricky because, think about Ford, 80% of their cars comprise US, well, 80% is produced here, and the components represent about 20% of their value added. So that's an issue. I mean, they could afford to pay those tariffs, whatever they end up being and now if there are tariffs on, GM and Stellantis are making much more of their cars being imported, and then you've got foreign imported cars from BMW to Toyota that are facing tariffs. What we've done here is protected Ford to a large extent. So we expect to see Ford's price go up, market price go up or down? We're kind of destroying Ford's competition. So we should expect U.S. companies should be benefiting in general from tariffs because it's eliminating reducing competition. Then you have other things like the fear of recession and allowing them to perhaps give lower wages, wage increases, and then at least because they say, well, this is going to be tough times. Everybody's saying that. And then you have inflation, which is yet to come, but you don't necessarily have to keep up with inflation when you give somebody a 3% wage, and if inflation turns out to be 5%, now you've cut real wages by 2%. So to some extent, we should be expecting the U.S. market to be doing well, but at the same time, we may be destroying our country economically to a significant degree. So just quick 2 cents on that one.
Well, as a reminder, Larry, since you are an investor with us,
proud investor.
We do a quarterly blog, and the quarterly blog this quarter, I don't know if you've had a chance. We always have a TLDR section, too long, did not read, to summarize it. These are usually 3 or 4 pages and somewhat technical, but kind of fun. I think they're fun. I think they're great.
Yeah.
But it was basically our views on the tariffs, and we think the tariffs are unsustainable. We don't think they make a lot of sense. We know they're inflationary. Anybody who denies that is crazy. And oh, by the way, the weaker dollar, as we've created some geopolitical unrest around the country and confidence in the country is, as a creditor, as a debtor, excuse me, is declining. That's inflationary too. I mean, if you basically have the dollar going from the dollar exchange going from 108 to 100, that 7.5, almost 8% reduction in the value of the dollar is inflationary for imported goods, and we're still going to import goods. We still are, and then you put tariffs on top of that. And my God.
Yeah, so that's in effect, another way of saying this is that the decline in the dollar, ignoring any price adjustments in the two countries, just that by itself is like you putting an 8% tariff, and we already have a 10% uniform tariff. Now we have an 18% tariff compared to before Trump was elected on foreign imports. And then it goes from there. If you're talking about China, we're talking about embargoing China. This is reminiscent of Roosevelt embargoing Japan before World War II, and that really kicked off Pearl Harbor. They had no way to get oil except invading Southeast Asia, the Dutch East Indies, and they were going to do it, but they didn't. They knew they were going to be in a war with the U.S. if they did that. So at the same time, I'm just listening to a podcast on Pearl Harbor. If I'm getting it right, at the same time they sent a fleet toward Pearl Harbor of carriers, they sent troop transport fleet down to whatever, Indonesia, and that's where they got oil during the war. So this raised the question whether the invasion of Taiwan is going to be imminent because the Chinese now have the perfect excuse. What they had before was a reason not to invade, which is sanctions. But it seems like this is our putting China in this position gives them the green light to invade, and we have no clear commitment to. We said we're going to defend, or Biden said we'll defend Taiwan. Maybe we'll send them band-aids. What does it mean to defend? If you say if you attack, you will have we will torpedo your boats. That's a different statement. We haven't said that. And from what we're doing in Ukraine, which is not to refurnish or resupply the Patriot missile systems, not to send new missiles. As far as I know, they have about a month's supply of Patriot missiles. So Russia will be free to do even more devastation in Kiev and other cities. Anyway, you take it away in your view of world affairs, then we'll get into kind of the near term U.S. Economic situation, what you see about that, and then we'll talk about. We have started to talk about the investment climate being maybe better than we thought, but and then we want to talk about how one goes about actually deciding how to invest in this environment, but also just in general, apart from what's going on in terms of our policies and the geopolitics, how you Fred, as how does your day work in terms of looking at a company, and what is it you look for, and what kind of homework do you do?
Well, let's talk about the geopolitical as it relates to our investment process, because it is not, except for overarching themes, demographics, fiscal policy, inflation outlook long term. Aside from those factors, we don't react to geopolitical events because we can't. We really can't. And they're so unpredictable, increasingly so with this administration. Are we going left or are we going right? And by the way, no comments that I make should be considered partisan, because as Larry knows, I'm about as middle of the road as you can get. I don't like either side of the aisle. And I think trying to blame past administrations, let's blame Biden, let's blame Trump. A lot of the fiscal recklessness that has existed in this country running deficits, in my view, it's that blame should be shared. And as Larry and I were discussing before this podcast, we started recording here, the problem we have is that neither party really wants to fight the deficit problem because they won't get elected. They really won't get elected. I don't know if we have a will in the absence of a major crisis. I don't think we have the will to fight that battle. So how does that impact our investment strategy? Well, let's start with the big picture. The big picture is we favor innovation and disruption because it's ongoing. I mean, look at what's going on with tariffs as it relates to manufacturing. What are we talking about? We're talking about, in our view, something a little unrealistic, but we're talking about robots everywhere, artificial intelligence everywhere. Let's ignore how expensive that investment is and how it duplicates the investments that have already been made in China and Vietnam and elsewhere. These Asian countries aren't full of stupid people. They're pretty smart. And a lot of them have already developed highly automated, highly efficient manufacturing systems to provide the world with certain goods. And so the point I'm making here is that right now we're being asked, we're being told as a country, we're going to manufacture everything here in the United States. Everything, by the way, is an overstatement. That wasn't said. We think, you can read our blog, we think that's pretty unrealistic. And we think I personally think it harkens back to a time of, kids playing out in the yard and this come home and the sprinklers on and daddy's coming home with his suit and tie and from working at IBM. And I mean, it harkens back to a different time and a different set of values. And I don't think, pardon me?
When people could buy $30, I guess, right?
Yeah, exactly.
The other day, don't buy $30. This is his Marianne.
Just buy one Barbie doll, that's enough, right?
Two Barbie dolls. And of course, most households can't afford one. Probably.
Right. Well, it looks like the households are going to afford what they decide to afford anyway.
And maybe that Barbie doll was made in China, right? Probably.
Absolutely. Absolutely. So our investment strategy really has two elements. First, we have a concentrated portfolio. So we don't own 50 or 100 individual holdings. We don't think that's necessary. We don't think that's functional. And we don't think that provides diversification, actually, because too often those 50 names or 100 names are all of the same sort, which is important to keep in mind. If you buy an ETF, or a mutual fund. Well, let me give an example, actually. So my investment colleague, Jack Shibley's fiance, was working at a firm and she was offered she looked at her 401k offerings and she asked Jack, what does he think of the 401k offerings? And there was international, there was emerging markets, and there was European, and there was an American, the S&P 500, obviously. And literally every one of those holdings, all 16 of them, every one of them held Microsoft.
Yeah.
Really? I mean, so what diversification are you really getting? Okay. Well, if you look at the S&P 500, as we know, the top 10 stocks still account for, 30% of the value, 35% of the value of the S&P 500. Is that diversification? Okay. So in our case, we own perhaps 24 holdings, 25 holdings. And unlike the situation 5 or 6 or 7 years ago, because I started managing money actually in late 14, early 15. I had been vice chairman of investment banking at Raymond James. I wanted to build another career. I had worked at Fidelity, actually, the summer of 1972, and concluded that investment management wasn't for me. And then I went to the investment banking business and the private equity investing business. And I said, now I think I can maybe kind of do this pretty effectively for family and friends. And it's kind of evolved into a business, quite a nice business. And so our views are that today are different than they were 5, 6, 7 years ago, because we believe that technology and innovation and disruption are very important. And by the way, most of those tools for productivity are anti-inflationary and are therefore not victimized by tariffs. They probably benefit somewhat from tariffs. They benefit from an inflationary environment. So that's a positive. But by the same token, we occasionally will run into situations, or I should say that such opportunities will present themselves that are pretty compelling. Let me give you an example. In 2022, I believe, or maybe it was 21, I don't remember exactly. You can Google it and we'll find out, but it's not important. And I was on with Maria Barbaromo And she asked me, what are you thinking about? I said,
Uh,
we're thinking,
CNBC.
that was no, she was at Fox, I think, at this point.
All right.
She'd been at CNBC. I was on with her at CNBC, but I was on with her at Fox now, and in this particular segment. And I said, I've never been an oil and gas investor. Occidental Petroleum had been a client of mine along the way, but I'd never been an investor in oil and gas. And she said to me, well, why are you interested in oil and gas? I said, because it's hated, it's demonized, and it's still necessary. ESG, this obsession with investing in environmental companies that have environmental awareness and responsibility and social consciousness and strong governance, ESG. Okay, that had really driven the oil and gas companies' values way down. By the way, they're still way down. They still sell at very low multiples, and they've been buying back stock. So unlike most growth companies that we want to invest in, who have high return on invested capital and have incremental investment returns that are equal to return on invested capital, that's an interesting calculation we do. Are the profits being reinvested at the same rate of profitability, or is that declining? So in the case of oil and gas, that whole sector has been returning capital through dividends and stock repurchases. It has not been a particularly fruitful sector for us. Actually, we've had ones that have been better. Some of our investments in AI-related things have worked out a lot better. But that day will come. More importantly, or more relevant perhaps to today's conversation as it relates to inflation, are our investments in precious metals, which are a pretty substantial portion of our portfolio. And I never would have expected 5 years ago that we would be talking about having such a large percentage, a meaningful, if you have 25 holdings and 3 or 4 are in precious metals and they're about equally weighted, that's a pretty
So
substantial.
what share of the portfolio now is in precious metals?
The position we've taken or believe is that inflation will be persistent, that there is not a lot of will to get the deficit under control. Fiscal policy will continue to run deficits. As you and I were discussing earlier, Larry, right now we're running, deficits equal to 6-7% of GDP. And that's not sustainable. And so, economic growth isn't running at 6 or 7%. And so there's just...
Yeah, economic growth is running at 0 right now.
Right, exactly.
And it's projected to be negative through the year.
Exactly. And that's one of the reasons that I think, we're highly selective. So, we don't trade, we spend a lot of time looking at our watch list, looking at our candidates, and we don't spend a lot of time actually executing on those trades because we wait. We want to wait. And, the one thing you want to do in the investment business is wait for the slow, fat pitch to come across the plate. You say, I can hit that. This works. And that allows us. So we basically build conviction about the company, build conviction about the management team. We do that through, reading, listening to earnings calls, reading all the public filings, accessing research from Wall Street firms, accessing research from independent research that we buy, because we do buy research from others than the Wall Street investment banks. And then we also use expert knowledge networks. So we actually will read interviews from former employees about the company, the quality of management as they see it. And those can provide some interesting insights. And it may be that we're looking at a company in the waste management business or remediation business, and we might read an interview by somebody about Clean Harbors. Now, we're not looking at Clean Harbors necessarily, but we're looking at that company. We're looking at a different company, but by reading about Clean Harbors, we get some additional perspective on the industry and the factors driving the industry. And we also may get some input as it relates to the company we're looking at, because the guy's talking about clean harbors, but he makes reference to another company. So that research is where we spend a lot of our time. We also spend a lot of our time looking at flows. We don't try to market time, but there are times when it becomes so obvious that we should be maybe building cash, or we should be investing cash. And usually the time we would want to be investing cash is when people are basically, figuratively speaking, at least, throwing themselves out the window, and the fear index is down at 12 or 14 or 15. That's the time you want to invest. Everybody talks about timing and it's impossible, and we largely agree with that. But the reason that timing is impossible is because people are so emotional. And anybody who denies that is, well, they're a pretty unusual individual. I know I'm emotional about investing, but I've learned to just control it, Fred. Come on. Your instincts, don't follow your instincts here. Don't do that. Don't get greedy, and also don't get excessively fearful. There's a great book out called The Hour Between Dog and Wolf. And it seems to be about investing. It's really not. It's about elite athletes. It's about investing. It's about about any of us who deal in the real world, and how our bodies and our minds are integrated. So if you make an investment and you make a lot of money on it, or trade, you buy a stock at 10, it goes to 12. Oh my gosh, I'm so smart. That builds confidence. It stimulates testosterone. There's actually, a hormonal reaction, which then starts to affect our brains, which then can lead us to making excessive bets on the upside. Likewise, you make a trade at 10, it goes to 7, and people get all fearful. It increases cortisol levels. It impacts your ability to invest, to take risk. And so all of those are real challenges for the individual investor. And it's one of the reasons individual investors, they either do it almost as a full-time job, and they can be successful doing that if they're very studious and very disciplined. But for most people, it's very difficult because you have other activities, and you don't have the ability to spend the time and the attention and the experience, quite honestly, to have lived through these cycles. This cycle right now reminds me of the 1980s, where I think we have, as you've pointed out, Larry, we have a slowing economy. Or maybe no GDP growth. We may be in a recession. Wouldn't surprise me if we are. And we have inflation at the same time. So that stagflationary environment.
Want more money, less risk, and a better life? Buy Money Magic, a new book by Lawrence Kotlikoff, Boston University economist, personal finance expert, and best-selling author. Whether it's education, career, marriage, housing, investing, retirement, Social Security, IRA, or 401k decisions, Money Magic delivers scores of secrets to raise your living standard. Financial journalist Jane Bryant Quinn says Money Magic is a must-read. Nobel laureate George Akerlof says Money Magic is quite probably the best financial advice book ever written. Financial guru John Malden says, you'll love this amazing book. It's full of wit, wisdom, and startling paths to a better financial life. And columnist Scott Burns calls Money Magic a funny, brilliant read, offering wildly powerful, unconventional choices that can literally change your life. Get Lawrence Kotlikoff's Money Magic today at Amazon, Barnes & Noble, and independent booksellers.
So let's just talk about let's say it's somebody down some middle class, upper middle class people that have some investments in a IRA, which or let's say it's a 401k, and they have maybe they have the ability to move it into, well, let's say it's an IRA, retirees, and they just had dinner with Gina, who's our landscaper for our little tiny yard here in our 1720 house. She gave us some landscaping advice, but she has a landscaping business. She was over with her partner last night for dinner, and she's telling us that she has 10 employees, and 3 of her big projects for the summer, which were with pretty wealthy people, were just canceled because people were fearful.
Mhm.
So now she has to lay off people. And then she starts telling about the other people that she's been interacting with who are saying the same thing, that she's seeing a recession already. I mean, I said, do you think the recession started? Oh, absolutely. Um, so now you have this volatility in the market. You have, uh, I guess my question is, yes, it is the case that the market goes down, then it comes back, and we look at uh, recent years and people have done really well. And you look at any 30-year holding period and the market's done well. But if we're, you know, if I look at 19, I've said this before, if you look at 1929, 1959, I think the market maybe in real terms just got back to where it was after 30 years. But if you look at 1930 and 1960, it's also done positively, but we're talking about 28 observations of annual returns that are the same. So statistically speaking, we're not talking about independent observations. So we only have 3 observations of long-term holding periods, but we're also talking about right now, I'm trying to direct us to people that don't have 30 years necessarily to wait for the
Mhm.
market.
Sure, sure.
And so I've been pushing because the yields on inflation index bonds are so high
Mhm.
relative to the past, or I mean, not astronomical at all, but so the 30-year tip, the Treasury inflation protected security is running around 2.5% right now,
Mhm.
which is quite high relative to the last 30 years. Uh, I've been pushing people to think about building a tips ladder with some portion of their resources because that can lock in their living standard floor, and then the rest they can put into equities, lane generational, for example, which it's nice to know that people don't have to have $20 million in order to invest in your
Oh, no,
because
not at all.
because I think that's, and uh, and then basically put in money in my view, at a certain age, you need to should put money into the market, into risky investments that you're prepared to lose basically 100%. Not count on spending out of that until you've left those risky investments and uh, and transformed your assets into inflation index bonds that you then you can spend more. But before that, and I call this upside investing, our Maxify.com software incorporates this as one of the ways you can look at your investing. You can also look at it in a more conventional full risk investing, spend out of both risky and safe assets. But it's a combination. Containing your future risk involves both deciding how aggressively to invest, but also how aggressively to spend. Are you going to spend out of things that are not for sure down the road? Anyway, would that be your 2 cents for somebody?
Yes,
Yeah.
I couldn't agree more. I mean, we do have a few clients, not too many, who basically have a certain amount of money with us, and they want distributions every quarter, every month, and mostly every quarter. So we know going out a year and a half, 2 years, we need to have a certain reserve put aside um, for those distributions. Now, the bigger picture, which we also focus on, is okay, if you have X amount of money with us and we've allocated 20% for those distributions or 15%, and then as if the market gets very strong, we may sell off some of those holdings and put it into the cash bucket to make those distributions on a going forward basis beyond the amount we've already reserved. We do have clients where that makes sense. But I want to address the other issue which you raised, which I think is important. And that is, could we have a decade of poor performance in equities? And my view on that is yes. And how come it hasn't already happened? Because I would have predicted I mean, I've said this before, I think on this podcast, on an earlier version of this podcast. I worked for many years with a guy named Tony James, who became the president of Blackstone. Brilliant guy, brilliant. And he was on one of the stations, I think CNBC, in 2019 or 2020, before COVID, as I recall, but could have been 19 as well before COVID. And he made the comment that he thought the decade of the 2020 to 2030 would be a lost decade for equities. Well, it hasn't been, oh, by the way. Now, that doesn't mean he's stupid. He's not, okay? It means that he couldn't have predicted COVID and stimulus and the amount and the level of deficits that we were willing to run. And that has obviously, in our view, pulled forward returns. So we basically had we've had strong earnings and strong returns that I think are going to be very hard to duplicate going forward. So you might say, well, gee, Fred, then aren't you just going to bonds? No, we're not going to bonds. And the reason we're not going to bonds is because we think the risk return there is poor.
Because of inflation.
Because of inflation. Correct. If you could, and by the way, I think inflation, people look at the personal consumer expenditures, they look at that component of inflation, and I think they're ignoring the fact that there's inflation in other parts of the economy too. I mean, the productions on the manufacturing side is also subject to a lot of inflation.
Yeah, let me just clarify that inflation impacts bonds. People tell me they've got a 50-50 portfolio, or maybe they're 80-20 bond stock, and that they're therefore in a safe place. But between 2019 and 2025, we've had an increase in prices of about 25%. So if you had, let's say you bought 10-year bonds back in 2019 and you held them because you were safe, so you would have lost 25% of your hot dog purchasing power. I always talk to people in terms of hot dogs. How much hot dogs do you end up with at the end of the day having made this investment? Well, just that inflation, which was unexpected back in 2019, when the inflation rate was running around zero, took away 25% of your real return. And of course, if you had, let's say, figured out after a couple of years, maybe in 2022, that inflation was kicking up and that you wanted to then sell your bonds because you're worried about getting watered down, which you'd already been to some degree, but you're worried about future watering down. Well, the market had jacked up interest rates at that point so that anticipating future watering down, future inflation. So if you sold the bond at that point, you would have sold it for, you would have experienced the loss of the hot dogs right then and there, as opposed to just holding the bond.
By the way, about 20% down in 2022. In 2022, the U.S. bond market, the TLT, which is the longer maturity bonds, performed worse than equities. Yeah. Equities were down 18%. I think the bonds were down 20%. Look, and by the way, what you just described is it's a perfect description of why Silicon Valley Bank and First Republic Bank basically became insolvent, because they had bought long-term bonds. God only knows what they were thinking, in order to grab another 100 basis points of yield. They could have been at the shorter end of the curve, buying 1-year paper, 2-year paper at 2%, 1.5%. No, let's buy 30-year paper and get 2.25% or 2.5%. It's like, really? 30-year paper? Are you nuts? So, because it should have been, it's pretty obvious that we couldn't have these low interest rates forever. And by the way, what we've done in this country with money printing and debasing our currency, and I use the term aggressively, debasing the currency, which is why we own precious metals. When I say precious metals, I want to describe what I mean by that. But we own gold and silver related companies, and the reason we do is because we think inflation is inevitable.
So you're probably hedging the economy, the world economy, but you're also investing in companies that are kind of have prospects that are independent of, they're going to do well no matter what the macroeconomy looks like.
Correct.
It's new technology that has great promise.
Correct.
And you're. Do you want to talk a bit about some of those technologies?
Most of those companies, Well, first, nothing that I say here should be construed as a recommendation, because in some cases, I'm not even going to name the company, but I will describe kind of what they do.
Oh, company X.
Yeah. But one of the things I do want to emphasize here is that, we may have an investment in a company and we may have bought it at X and now it's trading at 3X. And we probably still like it. And let me add one other thing, and that is that the things that get in the way of returns, okay, are basically trying to trade excessively and trying to time the market, paying too high fees. If you're using third-party managers, we charge 1%, by the way, which is on the low end, and I regret we ever set that as our fee rate, but we did, and we have to live with it. No performance fee, I might add. And then the other thing I think that really hurts is when people get focused on short-term gains and losses, and they trade too frequently, and there's a lot of tax breakage because the short-term tax rate is obviously high, ordinary income rates. And so
If you have a short-term capital gain and you realize within a year, I guess, right, you're going to have to pay the gain. It's going to be taxed at ordinary rates as opposed to capital gains rates, which are preferential rates. Yeah.
And that's a big differential. And so in our case, because we have separately managed accounts, Larry's account does not have the same holdings as an account. I mean, it's pretty much now parallel because Larry's been with us a while. But if someone sets up a new account with us, it'll take us 6 to 12 months in all likelihood to hold exactly the same holdings that Larry has, maybe a little less, but it's 6 to 12 months. But certainly it's going to take several months to have the same holdings that Larry has in his account, right? Because his account those were purchased at an earlier point in time.
Yeah.
And likewise, when we go through tax planning, which we do this for clients, we don't talk much about it, but we do. So Larry has, if he's got an IRA, then this is not relevant. But if he has a taxable account with us, then we basically will look at what would he generate in capital gains during the year, short term and long term, and how do we offset those with losses? Can we sell a position or part of a position? Because we can identify specific lots. So we may have bought some at X and some at 70% of X. So if we're going to sell some at a loss, maybe the holding that was done at X, that portion of the holding which was done at the higher price, can be sold. It can generate a loss. It can offset a gain, and so we want to be as tax efficient as we can. And frequently we will buy into a company at a 1% position, or even a 0.5% in some cases, and we're small enough that we can actually buy fairly small cap companies. We're very cautious with those companies because the quality of the management, the quality of research isn't as good. We have to dig hard to figure out what's going on with the company, and what's going on in their market. But we'll buy a company at X and we may add to it at 70% of X because we haven't lost conviction in the company. And by and large, staying with maintaining your research position, as long as you have conviction, don't let the price get in the way of your conviction. So we don't trade frequently. We do trade around rebalancing. We might make an investment in a holding. We all have heard a lot about NVIDIAs and the Palantirs of the world, and like a lot of investment managers, you might assume that we've held positions in those along the way. Well, if you held those stocks and you basically didn't sell because you remained convinced, it got to the point where you were really being reckless with the portfolio. You really had to sell because it could be 20 or 25 or 30% of your overall portfolio. I mean, if you buy a company at X and it becomes worth 15X, that can be fairly distortive and create, in our view, an irresponsible risk return profile. Ultimately, we're fiduciaries. We are not trying to, are we trying to outperform the market? Yes, of course we are. But are we trying to, but we also recognize that can be a fool's errand, particularly in light of the constraints we have with the overall portfolio, because a client may say to us, gee, I want you to take here's 100%. I want you to put 20% in a cash equivalent bucket for distributions. We can do that. Well, obviously, that's going to make the overall portfolio perform less well, but that's okay. I mean, that's, we're basically in the business of serving our clients' needs with
Trying to do financial planning for them through the back door, if you like.
Correct. I mean, we're doing the financial planning at a high level, and we're, kind of a 10,000-foot level, not a 5,000-foot level. I think the way your software works is terrific for most people. Most people don't have the courage to actually look at their spending. They don't want to confront it. But the truth is, that's how most people should be living their lives. Anybody who thinks they don't have a budget is kidding themselves. We all have a budget. I mean, obviously, if you're a multi-billionaire, your budget's kind of denominated in tens of millions and hundreds of millions.
Your kid's budget.
How financially secure do you feel? Imagine a tool to help you make smart financial decisions. A tool that factors in all your financial data and shows what you can safely spend every year for the rest of your life. That tool is Maxify. Powerful, accurate, and easy to use. Developed by Boston University economist Lawrence Kotlikoff, Maxify takes the guesswork out of financial decisions at every stage of life. Maxify calculates what you can afford to spend now and throughout retirement. And you can run what-if scenarios to see how your finances might change by taking a new job, buying a home, or downsizing. Knowing the impact before you decide lets you make smarter decisions so you can finally enjoy financial peace of mind. Are you ready? Visit Maxify.com today to start planning. That's Maxify with an I. Maxify, Maxify.com.
I had a person, just a little quick anecdote. I had somebody that I do at this point, we provide services. So one of our concierge service involves my taking a client and actually running them through our software for them and building their plan and then handing it over to them. I mean, it's there so that just go on board to their plan that they've set up, and looking at all the elements, including estate planning, because the tool can now handle that. And so we had a client who has like $35 million of assets in his 60s, and doesn't single kids, and I'm not giving the exact numbers. I'm changing the numbers a little bit, so it's not so suggestion is exactly want anybody to be identified here. But anyway, person said, was very successful in investing just by accident, like bought Amazon at a low price and held on to it, that kind of thing. And so has all this money. I said, well, you can he's spending down here, you could spend up here, single. Take some what about cruises? Nah, not really interested. Like my mom's here, we're nearby, I got to take care of her. So I said, well, let's run our program where you're putting a limit on your spending, and then we'll see exactly what you can do now. How much you're going to be leaving to your kids, your terminal estate, even if you make it to your last year of life. And we can also look at how much you'll leave along the way. And gee, now having done that, having you told me how much you are spending and can't get you to make that higher, here's what you are going to be leaving. And that's a lot of money. And by the way, by leaving it in your hands where your kids are got in much lower tax brackets, you're paying a lot of taxes. You're basically leaving it for Uncle Sam to a large extent. And you're also you're investing money at this point for your kids, not for yourself. Think about it that way. So now so I got him around to thinking about making gifts along the way, and also to think about his investment. How much risk does he want to put his kids at with respect to this money? Does he want to risk, if in the Great Recession, the market fell in half, would he possibly, if he has it mostly in equity, which he does, watch it drop in half and then decide at that point he'd had enough, and now he's lost half the kid's money? hasn't affected his living standard. So
I want to challenge you. No, just a second. It's true. The Great Recession, the indexes did fall, I think, as much as 50%. However,
yep.
it took a few years. It recovered. In fact, it recovered a lot of that fairly quickly. You may recall it. It did come back.
More than recovered, yeah.
So I think a lot of times, I think the important thing here.
No guarantee it would have.
Pardon me?
No guarantee at all from the data.
Well, yeah, but unless we think there's fundamentally a change, which by the way, maybe there is, in our systems and in our civilization, our culture, then I think you can predict that over the long run, markets will tend to go up. I mean, we are a society that is focused on economic growth. That's the altar at which we all worship.
Let me just say, I mean, the stock market historically from 25 through today has had about 7.5% real return. So there's this trend, and then there's these fluctuations, and then, but the Nikkei market, the Japanese stock market in '89 peaked. 30 years later, it was 35%.
I agree.
In nominal, 30 years later.
But that's Japan has its own special. And by the way, part of the reason that it took 30 years is because it got out of control. You and I were around and remember well, Larry, Japan was going to own the United States. Do you remember that in the 1990s? Early 1990s, they bought Rockefeller Center. They were going to own everything. Well, that didn't really work. And by the way, that we may be Japan. It's possible we're Japan. I agree with that. Question is, who's going to step up and become the largest economy in the world? It isn't China. China has its own issues. I mean, I think the problem that people have is that you have to blend conservatism and caution on the one hand with an awareness that we will in all likelihood have strong economic growth. And by the way, 7 or 8% real growth actually strikes me as, wow, that's a pretty good number. I mean, I was obviously aware of the number, but my point is that when you talk about your financial plan, I'm sure you say to people, you say, okay, what's your distribution need?
7.5% in the market, not 7.5% in the economy. The economy's
right.
Last quarter was negative 0.3.
Well, and by the way, I think markets have been driven, and all asset values have been driven for a long time by an unnaturally low interest rate, right? I mean, basically, free money drives investment, and that investment then drives prices higher. Sorry, I mean, if you look at real estate, around the country, having, people are like shocked at 6%, 7% mortgages. Well, I'm not shocked because, I've had a mortgage of 13% during my lifetime, or 12%. So I think, we've lived through an unnaturally low interest rate environment, which has driven equity prices higher. So I don't think, I wanted to echo what Tony James said back 5 or 6 years ago. I think, the next few years are going to be very difficult on returns, which is one of the reasons that we're focused in not just growth, in innovation, although we certainly are. And we're seeing, it's funny, the concentration on large cap tech has resulted in a world where there are good values, interesting companies out there that are either very small and emerging and rapidly growing. There aren't many. They're around, and they're well protected. They have good moats. They have good return on capital, and there are also companies out there that we think will benefit from the long-term inflationary trends. Where basically the asset values are substantially greater than how the company's valued. There are some oil and gas related companies in the offshore drilling rig business, in the offshore servicing business, servicing the rigs. There are companies in shipping and that are just selling at very, very low multiples, as if they're going out of business, and they're not. So I think we feel strongly that there are sectors of the economy that will do well, and there are areas for investment in commodities and real assets that will do well. And when we talk about gold as an example, we don't own physical gold in our portfolio. There's a way to hold it. We don't hold that. but we do all own companies in the streaming business, the royalty streaming business. We own companies in the mining business. We actually have a former colleague of mine at Donaldson, Lufkin and Jenrette, who's from whom we buy research, a guy named John Tomasos, who's a famous analyst. And he's our gold and silver and metals and mining resource.
Just a quick question. Why do you hold gold in the form of ownership of mines as opposed to the actual physical gold?
Because there's so much more leverage in terms of return to the upside. We're very, very bullish on gold, but the gold miners, who by the way have generally somewhat lagged gold for reasons that we don't fully understand. Gold has been driven, by the way, by central bank buying around the world, as you know, Larry. And since 2014, 2015, central banks have been very large buyers of gold. It's rumored that China has bought a multiple more tons of gold than they have announced. They've been a huge buyer of gold, and basically they're holding in reserves gold, a lot of these countries, as opposed to the U.S. Federal securities, federal bonds.
So Fred, maybe we could kind of bring this to conclusion by you talking about company X that might be one of the companies that you've been looking at or hold that's invested in some technology that's people are not super aware of, or that you find particularly interesting. Do you have a company like that you want to talk about?
Well, I think actually I'll mention two. Again, I won't go by name, but look, I can go by name. It's I don't want to play that game. I'm not recommending you buy the stocks. We own them at lower values in each case. We do still hold the stocks. One is called Spire Global, ticker symbol SPIR. When we bought into it, I mean, we really had to take a deep breath because it only had a market cap of about $150 million at the time, and it had a lot of debt. And so it was hard for us to accumulate a position because it's a very liquid stock. By the way, it's now trading at a higher valuation, and they've also issued some stock. So that combination has allowed us to have a little bit more liquidity in the stock. They also have had a tremendous amount of debt. They sold off part of their business, the marine business. This is a company that basically launches satellites and runs constellations and gathers data. This is a data gathering business. And they can predict weather, they predict fire risks, they can track fires, they can track floods. It's all radio frequency, by the way. This is not visual, it's not video data, it's actually radio frequency data. And we think AI, by the way, is going to further enhance their ability to sell that data and provide value. And they sell to government agencies and to the private sector as well, to insurance companies and things like that. So it's a very interesting company. We think it's very well. We think it's, we like it at this level even now. And it's been a situation where we've actually sold some at higher prices. It ran up quite a bit, and then we bought some more at lower prices. Letting the 30-day window, we can't, after we sell a stock,
can't do a watch deal, yeah.
Yeah, we can't. Yeah, we have a wash sale rule, so we have to hold off on the stock, but that generally hasn't been problematic. So that's an example. And then Jack found a company in the medical device area that is absolutely fascinating. And this is again, both these companies are what we put this in more of our high risk basket, more volatile basket. And that probably constitutes at any point in time, companies like this, they don't constitute more than 15% of our portfolio. But this is a company called ClearPoint Neuro. Again, this is a very speculative company in my opinion. But Jack identified the company, and basically we did a lot of research, and essentially the company makes positioning devices to allow for neurosurgeons to do brain surgery. Now, that in and of itself might not seem that interesting, although it's pretty interesting, particularly if your brain's getting operated on. But precise placement of devices is incredibly important in brain surgery for Parkinson's and things like that. But what they're really doing, and this is the important part, is they're actually working with drug companies on drug delivery systems. So they're basically, this is at the intersection of personal genetic-based medicine and basically technology to essentially develop and deliver to us drugs that could kill tumors that previously would be deadly, absolutely lethal. And they're making progress in that regard, and they're selling the systems. They're basically going to generate royalty income prospectively, at least from these drug arrangements. This could be a company that it could be very significant and quite large.
And this company's name is what?
ClearPoint Neuro.
ClearPoint.
Yeah, the ticker symbol CLPD. Now, again, we're not recommending the stock. We don't do that. Okay, I'm not doing that, but I am saying it's the kind of company that we did a lot of research on it. We bought it at earlier at much lower valuations, but it takes constant monitoring these companies as well, because things can go wrong. And so, obviously we listen to every quarterly call.
Like FDA approval may not come through or something, right?
You have that, and you have, changes in technology or a test that was seen as very critical to the company's growth. It may turn out that clinical application didn't really work. Yeah. So in that area, you always have those risks. Yeah, absolutely. So I like the medical device area on the one hand, but it's very hard. There's a lot of failures in that sector. The demographics obviously favor it. I think we look at, and each of those companies, by the way, when you think about it, aren't subject to much tariff risk. Not that we're particularly concerned about that, but the portfolio in general, it just happens. It isn't that we're particularly scared of it. Most of the portfolio does not have tariff risk. There are one or two companies that have some, but
so any final words for? We have lots of terrified, financially terrified people that are out there in the country today, and I think my Economics Matters podcast and newsletter and Financial Riddler, this whole Substack media platform, is growing like 1,000 people a day, which I thought was some kind of bot, but the Substack people assure me it's for real. So we're up to about 72,000 subscribers. They're all free. Unless they want to acquire some financial advice from me, they can pay a small amount, spend an hour with me, and then give them some ideas about what to do. But any,
I think your podcasts are terrific. You had Torsten Slack on, I think, recently, did you not, from Apollo? First rate.
Yeah, he's predicting a 90% probability of a recession, by the way.
Yeah, and I know I'm aware of that. And I think my advice would be, first examine, this is a time for caution, by the way. I mean, people are cautious. That will make people more, these things tend to have a reflexive impact. So your comment earlier about the landscaper and her wealthy clients basically pulling back. I mean, I see it down here in Florida. I live in Palm Beach part of the year. And I think people down here have changed. And oh, by the way, Palm Beach real estate will never go down. Well, it has gone down. Not a lot, but it's appreciated ridiculously. It trades at very silly valuations, in my opinion. And so people are pulling back, and I think that becomes contagious. Now, that is also a good time to consider investing, because when people are fearful, prices go down, right? And I'm not saying that about residential real estate necessarily, but I am saying that one of the problems with the equity markets is because it's priced every day, we can let emotions get in the way. My son's in the private equity business, okay? He provides valuations every quarter. and he tends to be very conservative on the valuations. He was actually criticized by some of his LPs recently for being too conservative. And he said, well, I don't want to come back to you at a future point in time and have marked the valuation down. So I feel very comfortable with this valuation. And he just raised another fund, I might add. So I'm very proud of him for that, but a bigger fund. And but the point I'm making here is because we mark our valuations every day to what the market says, and that can be subject to tremendous volatility. Most people, I think, need a financial advisor, and a financial advisor, by the way, who is talking to you about, oh, gee, you absolutely have to have a 60-40 because of your age, 60% bonds, 40% equities, or vice versa. I'd be suspicious of that person. I mean, look, I'm talking my own book here. We have a point of view. We feel strongly about our point of view. There will come a time, I keep telling Jack, there will come a point in time where we probably want to own bonds, but it's not yet. It's not now. It could happen, and that would be great. Okay, I wouldn't mind locking in, 8 or 9% or 10% bonds. I don't think we'll ever see that, by the way, because the country would go bankrupt or inflation would be out of control. But if we had the ability to lock in bonds at that price, that could end up being attractive.
Yeah.
It'll depend. But I mean, I think my advice in general is to don't pay too much attention to the headlines. If you're going to put money to work, do it when people don't think you're crazy to put it to work. That's always a good time. And don't necessarily put it to work in the most fashionable companies. That's not those companies. We have to ask ourselves, do we have an advantage here? Do we know something about this company that other people don't? And in some cases, the answer is yes. In most cases, the answer is no. So we have to be very careful finding opportunities. And the other thing is that, one thing I didn't mention is when we take positions in companies or decide to sell down part of our company, a part of a holding, because we want to rebalance the portfolio, we use some technical indicators. They're called DeMark indicators. We look for 9 days of up markets. That generally is going to lead to a down day, not always. And if you can see 8 or 9 weeks of an up market, then the stock is likely to face a significant reversal. But I think the other thing investors need to do is when they have a holding and it goes up 10% on one day, or it goes down 10% in one day, you have to ask yourself, is the company really worth 10% more today than it was yesterday? Or is the company really worth 10% less? What created that? And a lot of times, a lot of it, by the way, is bots. It's algorithms driving the market. When something is announced, let me give you an example. Okay, we're pretty convinced that Spire Global, the company I mentioned earlier, traded down a lot after an announcement that they were selling they traded up after they announced they were selling part of their business. Then there was a dispute with the buyer. The deal finally closed. We think that the stock traded down for a good period of time in the first quarter because all the algorithms said this is a company that's very heavily leveraged. There's a lot of risk in this company. And that wasn't true. So, we were pretty convinced, looking at the court filings and talking to the company and doing some other research as well, that the deal was going to close, and indeed it did, and the stock has traded up, not as much as we frankly thought it might, but that's okay. So I think my advice is stay calm.
Stay calm and carry on, right?
You stay calm, carry on, and work with trusted advisors. And Larry, I think your service is important, and people should avail themselves of it. I'm frankly, you're going to get overwhelmed if people figure out that you can provide a financial plan to them at a reasonably good rate. I mean, that's a tremendous value. People don't understand, I think, the value of that. You have to go through the process yourself. I've done it, of looking at your financial plan, and it gives you good peace of mind, and it can guide how you think about investing. So,
well, thank you, Fred, and thanks for coming on. And we'll have you back soon again. And
thank you, Larry. One quick advertisement. If people are interested in Lane Generational, just go to our website, lanegenerational.com. If you're interested in our quarterly blogs, go to Insights. click on the Insights tab. We produce those every quarter. You can subscribe to those. And if you find those to be, I think you'll find them to be pretty interesting. We usually post those on my LinkedIn page and on the Lane Generational LinkedIn page as well. But if you have an interest in further conversations, always interested in talking to people. Any conversation is generally an education, so that's a positive.
Good.
Larry, thank you so much.
Thank you, Fred.
Great. Okay, we'll talk soon. Bye-bye.